the right time. Hello and welcome to Hot Money on Bloomberg Quint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I am Darshan Mehta. Let's welcome our experts then. TS Harihar of HRBV Client Solution, Independent Investment Advisor Vivek Mavani, and Senthil Manikandan of Newberry Capital join me on the show. Thank you to all for joining me on the show. Today on Hot Money, we'll discuss some of the results that came out. SBI came out with numbers which disappointed the street. United Breweries came out with a strong set of numbers. The management commentary was also rather strong. Lumax Auto is trading at new record highs. Will the rally continue for the counter? We'll ask our guest, and we'll ask our guest what should they believe is the best consumption theme that they like. Most of the consumption stocks are trading at new highs. Which is the best pick among them? We'll ask them. So let's get on to the first stock, and that is State Bank of India. Came out with numbers, a massive 5,000 crore loss on the counter, and then some bit of clarifications coming out as far as the slippages is concerned. The counter managed to rally, but at the end of the day, it did saw selling off and came to the lowest point of the day. Again, today in today's trade, it's trading down almost 3%. What should one make of SBI numbers, and what's the view ahead for SBI? We'll ask our guest. So, Hari, I'll start with you. What do you make of the numbers that SBI came out with the commentary, and what should one do with the stock?
See, the loss per se was disappointing, especially if you consider that it is the third consecutive quarter that they're giving a loss. I don't think SBI has done that in the past. But I think if you look at it more pragmatically, what SBI has done is they have front-ended a lot of their investment write-offs which they had to do because of the rise in yields. So, while the RBI permitted them to do it over 4 quarters, I think they have front-ended most of their provisions in this quarter itself. So, I think to that extent it is good that there is not much more of pain left on the investment provisions front. Again, I'm assuming the yields don't go above 8%, which looks to be a remote possibility now. I think the only issue is the NPS cycle. There's not much of clarity whether the NPS cycle is totally bottomed out or not. But I would believe that for all PSUs, the NPS cycle should be close to bottoming out. So I would believe that at these levels, 296 or 300, the stock is quoting. Most of the negatives in the next 6 to 8 months seem to be factored in. So I would believe that, I would look at the positive side. I would believe the results are essentially saying that the worst is over. Now, probably we start looking at the stock a little seriously. Okay, that's the view that's coming in from Hari. The worst is over as per him, and should be accumulated at lower levels. Vivek, your view on the numbers?
Well, I mean, it's difficult to give a view on numbers for a management which for the last, 8 quarters or 10 quarters seem to be saying that the worst is over. I mean, probably last 3 or 4 years we have been hearing now worst being over, and every quarter there are fresh slippages on NPAs, number one. More provisions, which probably was not expected. So, in a sense, I'm not having much confidence on these numbers, whether the NPA cycle has indeed bottomed out, number one. Number two, we have a second complication in terms of rising interest rates and having to take provisions on their investment book. Now, if we were to believe RBI's stance, I don't think we are done with the interest rate hikes in the current cycle. So, next 12 to 18 months, interest rates, probably the trajectory will continue to go up, and hence the provisions on even the investment book will either increase or continue. I think it's in a trading range, and I think it's still too early to call that the worst is indeed over for the stock. Okay. It's a trading bet, and I wouldn't think of a long-term investment. Okay, we'll come back to you, Vivek, on this, but Senthil, your opening statement on SBI numbers?
So first, if you look at the loan growth has been in the tepid range. Like if you look at the overall loan growth has been in the range of 4.5%, and domestic loan growth is at the range of 7%. Management guidance is even in the bullish scenario, loan growth can't exceed 10%. So considering the sheer size of the balance sheet, so when you have a bank that doesn't able to grow about 10%, so the valuations will factor in this great item. So considering this, the stock is trading at around 1.2 times FI20 price to book multiple. I think I would prefer smaller PSBs like Vijaya Bank or Indian Bank, considering versus the SBI.
Okay, so that's the view that's coming in from Senthil. Smaller PSB banks like Vijaya Bank is something that he likes at this point of time. We'll open it up for discussion. Hari, management, and as Vivek pointed out, management quarter after quarter is saying worst is over, but the worst certainly doesn't seem to be over. The stock has run up significantly on the anticipation of good numbers. It is corrected a part of it, but still at these levels, do you think that it's the right opportunity to get in, or do you see more downside?
See, I would for a moment not give too much credence to what the management says. I think that I agree with Vivek that they have been, saying something and doing something in the last probably 2 or 3 years. That's absolutely right. I think what I would give credence is the speed at which the government is moving the NCLT, the speed at which cases are getting resolved. You can argue that haircuts are 50%, 40%, whatever, but I think at least cases are getting resolved. So to that extent, I would believe that in the next 2 or 3 years, we should see the NPS kind of getting out of the way and SBI continuing to build its book. So I'm looking at it more from that perspective. See, regarding rate hikes, I'm not sure how much higher than 8% the yields could really go from here. A lot would depend on what the US does. Because, the way US has behaved in the last 1 or 2 Fed meetings, I think at least one thing is clear that Donald Trump seems to be very averse to very aggressive hawkish rate policy. And that is showing in the way US is going a little slow, because they've already achieved a growth of 4.1%. They don't want to give it up. So I think if US doesn't get too aggressive, I don't see RBI getting very aggressive. And with oil where it is, about $70 to $80, the risk of oil does not seem to be too high in inflation. So I would believe that yields may not go too high, probably 25 basis points from here, but I think the risk of investment depreciation may not be too much as far as SBI is concerned.
Okay, Vivek, not too much confidence in SBI. Any other PSB bank that you feel that the management commentary was good and you would venture, you'd advise someone to get into it considering the valuations that they trade at?
Actually, I don't think one can, at least I can't make a case for investment in PSU banks. All of them probably, according to me, are in trading ranges, and they'll probably continue to be in trading ranges. My issue about long-term investing with PSU banks is, I'll agree partly with what Hari mentioned, that the speed at which government is determined to resolve things and set things right, NCLT, the speed and the recoveries which are happening. The larger issue, when the next investment cycle and the next credit cycle starts, are we fixing the governance issues in terms of the way loans are sanctioned and disbursed, whether the monitoring is effective in terms of utilization of those loans which have been given out to the corporates, whether fixing of accountability in terms of any kind of wrongdoing. Now, those issues still leave a lot to be desired, both on part of the government, on RBI, and even the individual banks, because finally individual banks can also take an initiative before RBI or the government. I mean, nobody stops the directors of every bank to do that. Now, till this system is put in place with corrective measures, probably this will keep recurring every few years or every couple of years. Every investment cycle we'll continue to have these problems. So all the PSU banks, according to me, are in trading ranges. So since we are talking about SBI, maybe at about 260 levels, maybe it's a buy. You buy on declines and sell the rally. So between 250 on the lower side, 300, 310 on the higher side, it's in a trading range, and you can play that range for a couple of times in a year. Same for other also.
Okay, so we need to move on to the next stock. The next stock that we want to talk about is United Breweries. Numbers came out on Friday. The numbers were decent. The management commentary was rather strong. 12% volume growth. The management spoke to us today and said that, if it was not the capacity constraints in UP, the volume growth would have been in excess of 12%. But what to make of it? The counter is already up 5%. What should one make of the numbers in the stock? We'll start with you, Senthil. Senthil, your view on United Breweries?
So Q1 has always been a strong quarter for the company. Like you mentioned, a volume growth of 12% is on the upper band of the management guidance for the whole year. So the whole year they have guided for 8 to 9% kind of volume growth. And like you mentioned, the UP, because of supply constraints, they were unable to post better growth. And also one major market was West Bengal. West Bengal, if you see the excise duty hike, the per bottle price has increased from 110 rupees nearly 145 rupees. So this has resulted in the market shift from beer to the country liquor. So the beer market in West Bengal has declined by nearly 40-45%. And West Bengal has been one of the large revenue generating market for them. So this has partially impacted the growth. But overall, I think Telangana has grown well, Rajasthan has grown well. So being a national player, I think going forward, 8 to 10% volume growth is a sustainable trend going forward.
Okay, that's a sustainable trend that's going forward. Hari, any view on United Breweries?
No, I've never been a big fan of that stock, because I've generally believed that it's a kind of a stock which is likely to come under pressure, if not economically, at least politically. Agreed that most of the economic problems pertaining to the previous management are through. But if you look at the political pressures, the social pressures that come in, especially we saw it in Bihar, Telangana is not talking about it. I think Andhra Pradesh is talking about it. Andhra Pradesh experimented once before. This is an industry, which is constantly under pressure, and there is always a huge, what I call the spurious market, or the unorganized market that is competing with them. So I'm not too positive. The numbers, I think 7-8% growth they're talking about seems to be a good growth, but I don't think I would really put my money into the stock at these prices.
Okay, you won't put it. And Vivek, would you have a view on United Breweries?
I don't track it, so I don't really have a view. But given the expected growth, at least when I see other reports and in the media, I'm not too excited, because there are a lot other consumption plays which are of much better quality, which have much lower risk factors for the sector as a whole. So I would rather focus my energies on some others, and I'll reserve my comments on United Breweries. I don't track it closely.
Okay, so that's the view that's coming in on United Breweries. We'll open it up for discussion. Senthil, what's the key trigger for United Breweries? How important is this West Bengal issue? They spoke to us. They say that it probably will be resolved, but do you see concerns that Hari put out in terms of restrictions coming into certain states, that being a big dampener for United Breweries?
So not only for United Breweries, across the alcohol space, either it be United Spirits or United Breweries, the regulatory impact is going to be major key negative factor that we can see. But if you study the history, there has been major instances where the states banning alcohol, and we have seen the spurious or the illicit alcohol coming in, and once again they removing the ban on the legal alcohol. This has happened in the last 25 to 30 years. So with a growing young population, and as such the demography is on the business side, I think there may be 1 or 2 instances across the states, but overall I think the potential for the business is strong. And if you see in the last 1 year, they have launched a Kingfisher Storm in the affordable premium category, and in the first full year of sale, it has done 1 million cases of sale. So like this, I think the company is having presence across the categories, and they have a market share of 50%, and so as such, I think the market is predominant, and being a market leader, I think one should have exposure to these two.
Okay, that's the view. Hari, is the concern that you said only for United Breweries or across the board?
Across, I think we have a concern on the sector overall, be it United Breweries, be it GM Breweries, I think KDR Distillery. We have a concern across the sector, because I think, let's not forget, we are approaching elections, and normally when the elections are approaching, you find all these states coming up with these weird ideas about banning liquor, catering to the women of the state. So I think all these things are now going to start in the next 1 year. So I would not be too positive on this stock at these levels.
Okay, so the contradictory views coming in on United Breweries. Senthil is rather positive on it. Hari is staying away from the sector. What we have, Vivek is saying that better themes to play rather than this stock. So that's the view that's coming in on United Breweries. The next stock we want to talk about is Lumax Auto Tech. The counter did manage to hit a record high in trade on Friday. Let's see what the counter is doing. It's up another 2%, closing in on the 200 mark. Will the rally continue? We'll ask our guest. So Vivek, I'll start with you. Any view on Lumax Auto? What do you make of the company?
Well, I've been looking at Lumax for a while now, and it's done, I would say, a fairly good job of deepening the penetration with their core customers. Firstly, they have a well-diversified customer, so everybody in the auto space, whether it is from two-wheelers, four-wheelers, CVs, to even off-road vehicle companies. I mean, Lumax has a meaningful share in their customers' procurement profile. Number one, they've been expanding the product range to cater to the wider and deepening those relationships. The stock has run up from a valuation point of view. When I look at in conjunction with return on capital, return on equity, it leaves a little to be desired in terms of improvement in the return ratios. Return on capital and return on equity historically has been only in the range of about 10 to 12%. There are hopes and promise of improvement on that, but I'll wait and watch. But given the low return ratios, the valuations to me at this point of time don't seem very attractive.
Okay, Senthil, your view on Lumax Auto?
So like Vivek mentioned, not only they have a well-diversified client mix, they also well-diversified product mix. So like from lighting, to the plastic molded products to sheet metal. So their revenue has been pretty much diversified versus if you look at other auto component players, they will be present in a very focused, very single product company. So with respect to the what is the volume growth or the sales growth that they saw in Q1 is based on because of a low base impact. But they also won a couple of order wins in the last year, so that will help them post sales growth in this year. Considering the sales growth and the strong balance sheet that the company possesses, the valuations are not comfortable at this range because the stock is trading at around nearly 25 times trailing 12 months earnings. And even on a bullish scenario, the stock is trading at around 17 to 18 times. So this is not much attractive for considering the auto component play that the company is into.
Okay, so two of our guests do believe that valuations is a big concern for Lumax Auto, and Hari, what's your view?
No, I would agree with Senthil that valuations, I think at 23 plus times are actually a little steep. But the whole problem with auto ancillaries is it's not a very homogeneous industry. Like, it's very hard to compare probably a Lumax Auto valuations with the Motherson Sumi or a Bharat Forge, because I think although they're technically auto components, I don't think they're exactly comparable because of the different nature of the products that they do. Lumax, I think, has a very strong share both in the OEM and the replacement market. So I think that is what probably holds in favor of Lumax. Number two, I think Lumax, I would look at it, forget about valuations, more as a derivative play. So it's a play on the auto sector. And I think as the auto sector, keeps picking up demand, and you see every auto number that comes out month after month, be it Maruti, be it Tata Motors, be it Mahindra and Mahindra, I think phenomenal growth they're able to show. And I think that should reflect on the demand profile of Lumax. So purely as a macro view, I would believe that Lumax is a stock worth buying at these levels.
Okay, so that's the view that's coming in from Lumax Auto. We'll open it up for discussion. Vivek, any other auto stock that you like? Apart from Lumax, you found it to be expensive. Anything that looks attractive in this space? Or
Well, basically my preference is for companies which have a return on capital, return on equity, which is much higher than 10-12%. I mean, typically I would have a benchmark of at least 18%. And that's what according to me, is a long-term sustainable for any business. That is the required, I would say. Swaraj Engines is something that I find much better in terms of valuation to return on capital, return on equity mix. I mean, it's a debt-free company, close to 150 crores of surplus cash on the balance sheet. Return on capital, return on equity adjusted for cash would be in excess of 60%, but with the cash also it's about 35%, and it's trading at about 24-25 times next year earnings. Direct play on the tractors because they supply the tractor engines to the North India business of Mahindra and Mahindra, what used to be erstwhile Punjab Tractors. So this used to be the sister company of Punjab Tractors. Mahindra and Mahindra is one of the promoter companies. Kirloskar Group is the other. So I would within auto ancillaries, I find Swaraj Engines as the best play.
Okay, Swaraj Engines is the best play. And Senthil, since you also find this expensive, anything that you're recommending in the auto anc space to your clients?
So we like Harihar seedings in the auto component space, particularly after the recent correction the stock has seen. Particularly if you look at the management, it's part of the TVS group, and the sales growth in the long term, like 5-7 years, CAGR has been in the range of 8 to 9%, but the bottom line has been growing at a range of 20%. And considering the client profile that the company has, and it is like even if the electric vehicles come in, majority of the auto component players will get impacted, but Harihar seatings being in the seating player, it won't be impacted by the electric vehicle phenomenon. And valuations are quite attractive. It's trading at around a range of 14-15 times trailing 12-month earnings, and management quality is very strong, so we prefer this stock.
Okay, and Hari, finally, any other auto anc? You said that you like Lumax. Any other auto anc companies that you're recommending to your clients?
See, more than auto ancillary equipment, we like tires a lot. Though it is not technically classified as auto ancillary, we believe that tires could have the twin advantage of one, pick up in auto demand, and two, lower rubber prices. And I think it's a kind of I would say a double advantage that tire companies are having. And if you look at any of the tire stocks, be it Apollo, be it MRF, forget about its expensive price that it quotes at. But any of these stocks have done very well, and I think tire stocks are the one to really watch out for the next probably 2 to 3 quarters. So more than any of the other ancillary equipment makers, we would like prefer tire stocks like Apollo. I'm just leaving out MRF considering the price, but JK tires, I think these are the ones that look really good at these prices. Okay,
so that's the view that's coming in on Lumax Auto and the entire auto anc space. Swaraj Engines is something that Vivek likes. He finds Lumax Auto expensive. Harihar Seatings is something that Senthil spoke about. Even he finds Lumax Auto expensive. Hari likes Lumax Auto. He said it should be bought, but tires would be the preferred space as a quasi auto anchor play in as far as the portfolio is concerned. And the final stock that we want to talk about, it's more of we are giving our experts the choice to select the stock. More of a lot of consumption stocks have moved up significantly. So we're asking our guest which is the best consumption play that they like and what's the rationale for it. So Hari, I'll start with you. Which stock do you think is the best consumption play as of now?
See, it's a difficult call on consumption because I think most of the stocks that I see are either quoting at lifetime highs or they're probably quoting at very, very rich valuations. But I think if I was to pick two stocks, then one would be Britannia on the FMCG space and Havells on the consumer electronics space. I think Havells to me looks to be a very good bet on the post-GST scenario, which is going to be more organized, less unorganized. And after the acquisition of Lloyd's, I think they have a exposure not only to electrical equipment but also to white goods, air conditioners. So I think Havells to me looks to be a good bet. Britannia, I think they've done a couple of right things. They have expanded the biscuit market substantially in the last 1 year. The latest issue of bonus debentures is going to be useful in the sense that the stock is going to be in demand. Number two, not too much of price coming down, and number three, cost of equity is going to come down because the debt component goes up for Britannia. So I think both Britannia and Havells seem to be making the right noises, and we would look at these two stocks at current levels.
Okay, both of them trading near record highs. Both of them have expensive valuation. Despite that, you believe that they deserve the kind of valuation, and you see the valuation sustaining at these levels?
Hard to say if they deserve, but I would believe they would continue to quote at these kind of valuations because when you look at a major thrust on consumption, even if let's say a Britannia can continue to quote at 45-50 times earnings, I think that should be good enough because it should grow along with the growth in business.
Okay, that's the view. So Britannia and Havells are the stocks that Hari likes at this point of time. Vivek, what do you like in the consumption space?
Well, just extension to what Hari mentioned, that in the consumption space, yes, valuations are rich. So not only are they trading at lifetime highs in terms of absolute stock prices, but even when you look at valuation in terms of multiples, whatever multiples, whether you take EV by EBITDA or P ratio or cash earnings or whatever, I mean, even that is at close to a decadal high. So in that context, my preference is for companies which have very high return on equity, return on capital, free cash flows, and have much higher dividend payouts. And there, my preferred bet is Nestle, which has probably a 20-25 year track record of earning return on capital and return on equity in excess of 50%. After hiccups on the Maggi issue 3 years ago, the growth is back and roaring double-digit, both volume and price growth with little of price adjustments. Growth going forward to be driven by new products, which are going to be at least 10-15 products or products and SKUs in the next 12 to 18 months, and much greater distribution efficiency driving it. So on valuations, it's about 55 times current year earnings, maybe about 46, 47 times next year earnings. But when we are looking at the entire consumption pack within that range in terms of valuation multiple, Nestle scores much higher in terms of return on capital, return on equity, dividend payouts, free cash flows, and so on and so forth. I'll agree with Hari's point on Britannia also. Britannia also trades similar. My preference is for Nestle.
Okay, Nestle is the stock, but Vivek, you said that valuations do you find valuations to be expensive? You said that valuations could be, but there are these other factors. But on an absolute term, do you find valuations?
So long as they deliver, so long as all of them deliver on double-digit growth, I think these valuations will sustain. I mean, the speed breaker, the moment you see a speed breaker, maybe not for the entire sector, but for individual companies, some of these valuations will derate. So whether you take Titan at one extreme, whether you take FMCG, whether it's all of them have been delivering double-digit growth, close to 20% earnings growth year after year, quarter after quarter, and there seems to be no let-up in that. So long as the growth continues, I think these valuations will sustain, because let's also not forget, when you look at the entire market across all sectors, this is one sector where most companies are, in terms of quality, very good. None of them have balance sheet issues. All of them generate free cash flows. Most of them don't have debt, barring a couple of companies. All of them have return on capital, return on equity, which is at least higher than the market averages. So I think this consumption theme can go on. The multiple, so long as the growth sustains, will also sustain. The moment the growth hits a speed breaker, probably some of these valuations may also correct. But I think one can still play along.
And will Maggi be the core trigger for Nestle, or is there something else you believe that will come?
Well, besides Maggi also, Nestle is getting into new product categories. One of them is breakfast cereals. They're getting into product extensions both on the, on the Milkmaid side, on chocolate side. Maggi, after the issue which had happened 3 years ago, it's back to more than 20% growth for the entire product range. So obviously that's one of the triggers, but there are multiple other triggers where all of these segments are firing up on growth at in excess of 15% volume growth.
Okay, that's the view that's coming in on Nestle. Vivek likes Nestle, and Senthil, which is the preferred pick in the consumption space?
So we like Titan in the pick. So as they say, valuations are going to be the slave of the earnings. I think as long as the earnings growth remains for the entire consumption bank, I think the valuations are going to sustain. And what we're seeing is the valuations are same for the consumer staples and also consumer discretionary plays. So I think the consumer staples, we have seen the growth in the last 3-4 quarters because of the low base. So that is not going to sustain. So we are quite bullish on the consumer discretionary space. And within that, we like Titan particularly because if you look at the entire jewelry market, the market size is nearly 50 billion. And Titan is the largest organized player. Its market share is in single digits. And last year and off, we have seen how the trust has been lost by the couple of major jewelry players in the market. So Titan with the Tata brand and the trust, I think it has a long runway ahead. And the management's guidance of 25% growth in the jewelry segment is quite positive. And as long as this growth sustains and the opening of new stores, and with the market gradually shifting towards organized with GST, the more complaints coming in, I think Titan is the preferred pick among the consumption.
Okay, what's the key trigger? One or two specific key triggers why you believe that growth will come in already on a base which is now increasing for Titan?
So one thing is they're entering more focus on the wedding segment and the studded jewelry segment.
Okay.
So both these segments are quite high margin accretive going forward. I think they could be adding around 1-2.5% margins in the next 2 to 3 years in the jewelry segment. And second one could be the watches segment. The margins are quite high in the Q1, but the margins could normalize in the going forward quarters. What you are seeing is the market size is predominantly high. So if you consider the other consumption plays like HUL or UNB, Nestle or Britannia, their market share in their product categories in the upwards of 40-50%. Okay. But if you look at Titan, their market share is single digits. So that's where I'm seeing the growth potential going forward.
Okay, so the consumption play, the stocks that have been spoken by our experts, Havells as well as Britannia, something that Hari likes, Vivek likes Nestle India, and Titan is the stock that Senthil likes at this point of time. But we've run out of time on today's Hot Money. With that, it's a wrap on today's Hot Money. Ask BQ comes up next. Hari, thank you so much for coming in. Vivek and Senthil also thank you for coming in. Ask BQ comes up next. Stay tuned to Bloomberg Quint.